Did you know that some financial markets, well, they operate under rules that are fundamentally different? It's fascinating how deeply certain ethical principles can shape global investment.
It really is. People often think of finance as this one big uniform thing.
Exactly. But today we're peeling back a layer, looking at a really meticulous system rooted in Islamic principles. Specifically, we're doing a deep dive into the Dubai financial market's Sharia standards for issuing, acquiring, and trading shares, the DFM our
Right.
mission, to unpack these rules, figure out their purpose, and really reveal the nitty-gritty parameters that define what makes an investment Sharia compliant.
It's very specific.
Very specific. We're basing this on the official DFM standard for issuing, acquiring, and trading shares document, the PDF, and also its key update, the addendum no. 1 for the DFM issuing and trading shares.pdf.
And that addendum from 2023 is crucial. Yeah. It changed some important things.
So this isn't just general ethical investing talk. This is about hard rules. And for you, listen in, this is hopefully a shortcut to understanding a complex but really influential area of finance. We'll get into details you probably won't find easily elsewhere. So where do we start? What's the big picture on how the DFM actually approached putting these Sharia compliance rules together?
Well, what's really striking is just how systematic they've been. The DFM has codified Sharia compliance to an impressive degree. This standard, it wasn't just a one-off. It started back in 2008.
Okay.
And it's been updated several times. There were significant revisions in 2013, 2018, and then, as you mentioned, that really important addendum number 1 in February 2023. It's much more than just a guideline.
So it's like a blueprint.
Exactly, a blueprint for what's permissible, what's halal in the Islamic capital market.
Yeah.
And it reflects a much broader vision.
Right, that vision piece is key. The whole Islamic financial industry has grown massively, and Dubai's often been right at the center, hasn't it? I mean, you think about the first Islamic private bank, Dubai Islamic Bank, DIB, that was founded right there in Dubai, way back in '75.
Yeah, pioneering stuff.
And then the first international Islamic bank, IDB, in Jeddah, soon after. That kind of growth sort of paved the way for standards like the DFMs, I suppose.
It did. And this DFM standard, it's directly linked to His Highness Sheikh Mohammed bin Rashid Al Maktoum's vision. The big goal, make Dubai the capital of the Islamic economy.
Okay.
And the body responsible for setting and policing these rules is the Fatwa and Sharia Supervisory Board. The documents just call it the Sharia Board most of the time.
And they do more than just write the rules.
Oh yeah, much more. They issue binding resolutions, they have to endorse specific finance products or ways of doing deals, and crucially, they perform Sharia audits. They check that companies are actually sticking to the rules.
So a huge responsibility on that board. Now, the document mentions they developed the standard under, and a quote, undesirable circumstances. What does that actually mean? What were the challenges?
Yeah, that phrase, undesirable circumstances, it basically refers to the reality of the modern business world. The fact that interest-based dealings and other contracts forbidden under Sharia are just everywhere. They're very common in conventional finance.
Right, it's hard to avoid.
Exactly. So this shows the DFM and its Sharia board being really proactive. They didn't just sit back and say, well, it's all non-compliant. Instead, they built a framework to actively, purify investments where possible.
Purify.
Yeah, to make Islamic finance a real practical choice, even when operating within that wider conventional system. The standard tries to meticulously screen for what's halal permissible without just slamming the door on all investment.
So it's pragmatic.
It is, and there's an underlying optimism, I think. The idea is that if more companies adhere to these standards, it could lead to positive changes in the whole financial system over time. But fundamentally, it lets the DFM clearly label companies Sharia-compliant or non-Sharia-compliant.
It's amazing how detailed it gets. Okay, so let's say a company wants to be listed as compliant, or an investor wants to buy shares. What's the first filter? What are the rules around the company's actual objectives and activities?
Right. This is section 2.1, the core business test, basically. There are 3 main ways a company's objectives and activities can be deemed okay for share acquisition.
Okay, what's the first?
The simplest way is if the company's official documents, its articles of association, clearly state that its objectives and main activities are permissible under Sharia. Straightforward.
Makes sense. What if the articles are vague?
Good question. If the articles don't explicitly say, then the company needs to have its own internal Sharia board. And importantly, that board's decisions must be binding on the company's management. That ensures compliance from the inside.
Ah, so an internal check. And the third way?
The third way is interesting. It covers companies whose articles do actually mention some impermissible activities.
Oh, so they can still be compliant?
Potentially, yes. If it can be verified, usually through their audited financial statements, that those specific impermissible activities are actually suspended, and the company isn't really doing them in practice.
So what's written down matters, but what actually happens matters more.
Exactly. It shows a practical approach, especially for older companies that might have outdated articles.
Okay, that's quite nuanced. But then, as you said, there's a clear line. What kinds of activities are absolutely forbidden? What makes an objective non-Sharia? Give us some examples.
Oh, the list in Section 2.2 is long and very specific. It really paints a picture of the underlying ethical framework. For instance, anything involving interest riba is out. So interest-based lending, borrowing,
The core of conventional banking, really.
pretty much. Also conventional financing activities, conventional investment funds, conventional insurance, all listed as non-Sharia objectives. The principle is avoiding interest and excessive uncertainty and favoring risk sharing.
Okay, what else? Beyond finance.
Well, trade in forbidden products. Things like pork, alcohol, or liquors at the standard terms, at narcotics, unless for legitimate medical use, and tobacco.
Right.
Gambling is a definite no-go. Dealing in pornography or anything else that goes against Islamic ethics is prohibited.
And it seems to go deeper into social issues, too.
It does. There's a strong focus on human dignity. So any inhuman or unethical dealing involving people is forbidden. Think human trafficking, trading in human organs, prostitution, all explicitly listed.
Wow.
And it even extends to broader societal concerns. Activities harmful to the environment are listed.
Really, environmental harm.
Yes.
Yeah.
And dealing in materials that jeopardize public health. Also, certain types of biological research, if they conflict with Sharia principles like human cloning or determining embryo sex for non-medical reasons.
So genetic engineering, too.
Some aspects, yes. Specifically, hereditary or genetic engineering that leads to nature change, unless it has a clear Sharia-compliant medical purpose.
This is incredibly comprehensive. It's far beyond just avoiding alcohol and gambling stocks.
Absolutely. It's about promoting businesses involved in real ethical economic activity, sharing risk fairly, and contributing positively, or at least not negatively, to society and the environment. It's a whole worldview embedded in finance.
Okay, so that's the activity filter. But you mentioned mixed activities. What happens if a company's main business is, okay, say manufacturing widgets, but maybe they earn a little interest on their cash reserves or have a small sideline that isn't compliant?
Right. That's where Section 3, companies of mixed activities, comes in with strict financial limits. Even if the core business is fine, the finances have to be screened.
So numerical thresholds.
Exactly. Two key ones. First, relating to interest-based debt. A company is prohibited if its total average interest-based lending or its total average interest-based borrowing exceeds 30% of its total assets.
30% of total assets.
Yes, based on the average over the last financial period, which is usually 3 months.
Right.
So if either their lending or their borrowing on interest crosses that 30% line, it's deemed non-compliant for acquisition or subscription.
And that's an or, not an and.
Correct. Either lending or borrowing exceeding 30% is enough to fail the test. And it's crucial to note, even if they're below 30%, any income earned from interest-based activities is still considered prohibited and needs to be dealt with separately purified.
We'll definitely come back to that purification idea. What's the second threshold?
The second one relates to income from non-Sharia's business activities, other than that temporary interest stuff we just discussed. This is covered in Section 3.5, the prohibited income rule.
Okay.
If the income generated from these non-Sharia business lines exceeds 10% of the company's total income, then acquiring or trading its shares is not permitted.
10% of total income, that seems quite tight.
It is. And again, like with the interest income, even if the company's below that 10% threshold, any amount of income earned from those non-Sharia activities, no matter how tiny, is still considered prohibited. It must be segregated and disposed of.
Segregated and disposed of. Okay, so these percentages, the 30% for debt, the 10% for income, they're obviously critical. How does the standard make sure these numbers are reliable? Can companies just, estimate?
No, absolutely not. Section 3.5.1 is very strict on this. The calculations must be based on the company's latest audited balance sheet or financial statements.
Audited only.
Yes. Unaudited figures don't count. That adds a necessary layer of verification and trustworthiness to the process.
And what if the statements aren't clear about where some income comes from, like other revenues?
Good point. The standard requires companies to disclose the source and nature of things like other investments or revenues if it's not already specified. If they don't, or if it's still unclear, the matter gets referred up to the Sharia board for a ruling. Transparency is key.
Okay, that makes sense. So we've covered the company's activities and its financial health according to these ratios. Now, let's move on to the actual trading of shares. You mentioned earlier there have been some significant updates here. What was the rule originally and what changed?
Yes, this is a really important evolution, mainly driven by that addendum number 1 from 2023. Let's look at the original rule first, which was in paragraphs 4.1 and 4.2 of the standard.
Okay.
Originally, for existing companies already listed, you could only trade their shares if their non-cash and non-debt assets, think physical assets, inventory, maybe some intangibles, made up at least 10% of their total assets.
10% minimum in real stuff.
Kind of, yeah. And for new companies wanting to list, they had to convert at least 10% of their initial capital into these non-cash assets before trading could even begin.
What was the logic behind that 10% rule?
The underlying idea, the principle, was to prevent trading in companies that were essentially just pools of cash or debt. It aimed to curb speculation on purely monetary assets and ensure trading was linked, at least somewhat, to tangible economic activity or assets. If a company only dealt in cash or debts, trading its shares wasn't allowed under those general rules.
Right. So what did the 2023 addendum do?
It completely repealed paragraphs 4.1 and 4.2.
Repealed them. So the 10% rule is gone.
Gone. That's the big shift. The DFM no longer imposes that general 10% minimum physical asset requirement for trading across the board.
So what's the rule now for companies that are mostly cash or debt, like maybe some financial institutions?
The addendum replaced those paragraphs with a new clause. It basically says, and I'm paraphrasing slightly, if a company's activity is solely based on cash and or debts, then the specific Sharia rulings for trading in cash and or debts will apply.
So instead of a general ban or a 10% hurdle, it shifts to applying very specific, possibly stricter rules designed for trading those types of assets.
Exactly. It seems to be a more nuanced approach, acknowledging that some legitimate businesses are primarily cash debt-based, but ensuring they are still traded according to the relevant Sharia principles for those specific asset types, rather than applying a blunt instrument like the 10% rule.
That's a really interesting adaptation. Okay, so shifting gears slightly, what happens if things go wrong? Say, a company was compliant, but something changes and it breaches the rules. Or what if I, as a shareholder, find out my investment is suddenly non-compliant?
Good question. Section 4.4 deals with this breach of Sharia parameters. It sets out obligations for both the shareholder and the company.
Okay, what about the shareholder first? If I own shares and they become non-compliant?
Your obligation as the shareholder is quite clear. If you find out about the breach, you must sell those shares immediately if you could do so without making a loss.
Immediately if no loss. What if selling immediately would cause a loss?
Then the standard gives you some leeway. You have a maximum of 30 days to sell the shares.
30 days grace period to avoid a loss. Okay. And what about any profit I might make from that forced sale?
Interestingly, the standard explicitly states you are not obliged to dispose of or purify any capital gain you receive from selling those non-compliant shares under these circumstances.
That is interesting. So the focus is on getting out of the non-compliant investment, not penalizing the exiting shareholders' gains. What about the company's side?
If a company breaches compliance, it has a chance to fix things. It must rectify the situation within 3 months. That 3-month clock starts from the end of the financial period on which the Sharia board based its non-compliance decision.
And can you still trade the shares during that 3-month fixing period?
Yes, trading is permitted during the rectification period. It gives the market some stability. But if the company fails to fix the breach within those 3 months,
Then what?
then the DFM officially reclassifies the company as non-Sharia compliant. And importantly, a company only gets one shot at rectification per year. They can't keep slipping in and out of compliance. It underlines the seriousness of maintaining the standards.
One chance per year. That's strict. Now, what about a different scenario? What if someone deliberately buys shares in a non-compliant company with the specific goal of making it compliant, like an activist investor, but for Sharia reasons?
Yes, that's covered too in Section 5. Acquiring shares for conversion or rectification. It's actually permissible.
It is, even though the company is currently non-compliant.
Yes, if the clear stated intention is to convert the company into a fully Sharia-compliant one. But there are conditions.
Such as?
The purchaser, the one buying the shares, has to demonstrate they actually have the capability to make the conversion happen. Maybe they're buying a controlling stake or enough shares to influence management significantly.
So you need power and a plan.
Exactly. You need a clear plan for conversion. And it has to be achievable within a reasonable time frame, which the standard caps at a maximum of 2 years.
2 years max.
And it's not done quietly. The Sharia board has to issue a formal resolution approving this plan, and the DFM then announces it publicly to the market. So everyone knows this conversion attempt is underway.
Transparency again. And during that conversion period, what about prohibited income?
Good point. Even while the conversion is happening, any prohibited income the company generates must still be segregated and disposed of according to the rules. The conversion attempt doesn't give a free pass on purification.
And if the conversion fails, if they don't manage it in 2 years?
Then the shares acquired for that purpose must be sold. The attempt failed, so the justification for holding non-compliant shares disappears. It's a pragmatic rule that allows for positive change, but has clear boundaries.
Okay, this brings us back neatly to that idea of purification. You've mentioned it a few times regarding prohibited income. Can you explain that concept a bit more? What does exclusion of prohibited income mean for the typical investor?
Right, Section 6 details this, and it's a really fundamental part of Sharia-compliant investing. It's about ensuring you don't personally benefit from any haram or forbidden earnings your investment might have generated, even if the company itself is broadly compliant.
So even in a compliant company, there might be tiny bits of prohibited income.
Yes, maybe from interest on a bank account, or that small non-Sharia sideline that fell below the 10% threshold, if the company itself hasn't already segregated and disposed of this income before paying out dividends or profits.
Then the responsibility falls on the shareholder.
Correct. At the time profits are distributed, you, the shareholder, are responsible for calculating and purifying your portion of that prohibited income.
How do you calculate that?
The standard gives a formula in Section 6.4. You take the company's total haram income, divide it by the total number of shares issued, and then multiply that result by the number of shares you own. That gives you the exact amount you need to exclude.
Exclude and do what with?
Dispose of it. Give it away, usually to charity. The absolute key principle, stated in Section 6.8, is that neither the company nor the shareholder can benefit from this prohibited income in any way.
So you can't use it to pay your taxes?
Yeah.
Or pay off debts?
No, absolutely not. Can't use it for taxes, can't use it to pay interest you owe, can't use it against your own liabilities. It has to be completely removed from your benefit.
And this applies always, even if the company made an overall loss?
Yes. Sections 6.5 and 6.6 make it clear. It applies regardless of the company's profit or loss situation, whether it actually distributes profits or not, and whether you held the shares for long-term investment or just short-term trading. If prohibited income was earned during your holding period, your share needs purification.
What if I sell the shares before the company distributes profits?
In that case, Section 6 clarifies that the obligation doesn't fall on you for purification related to that period's earnings. The focus is on purifying distributed profits or benefits received while holding.
Okay, that's clear. Purification is a serious ongoing responsibility for the investor. Now, what about the initial issuance of shares or other specific transaction types? Are there special rules there?
Yes. Section 7, issuance and subscription to shares, covers some important ground. For example, it explicitly permits companies to have limited liability, meaning liability is limited to the capital invested, provided this is clearly declared publicly. It's about avoiding deception.
Transparency again.
Exactly. It also allows companies to add a subscription premium when issuing shares, if it's fair and reasonable. And they can issue new shares later on at a fair price, based on an expert market valuation, to raise more capital.
Can you buy shares using Islamic finance contracts?
Yes. Section 7.4 explicitly permits purchasing shares using contracts like murabaha. That's where the seller tells you the cost and the profit margin up front. Or musawama, which is more like a simple negotiation without the cost disclosure. Both avoid interest.
Okay. Now, you mentioned something intriguing earlier about lending shares. There seemed to be a permission and a prohibition.
Yes, it's a subtle but important distinction reflecting Sharia precision. Section 7.7 does permit lending shares, but only through a specific contract called i'ara, which is essentially a gratuitous loan, like borrowing a tool.
Okay.
And it's only allowed for specific, non-speculative purposes, like allowing the borrower to pledge the shares as security or letting them receive the dividends. Critically, under i'ara, the borrower cannot sell the shares, except maybe to enforce the pledge if needed.
So, very restricted lending.
Very. Then later, Section 8.1.8 states broadly that leasing or lending shares is not permissible. This is a contradiction. It means general commercial share lending or leasing, especially if it resembles interest-bearing loans or facilitates things like short selling, is forbidden. Only that very specific, limited, non-exploitative IARA is allowed. It shows how the intent and structure of the transaction are paramount.
That highlights the level of detail. Finally, let's touch on some other specific financial instruments or practices the standard explicitly forbids. What are some key unlawful transactions listed in Section 8.1?
There are quite a few, and they really underscore the core principles. One is the INA sale, or Bay al-Ina.
INA sales.
Yeah, it's seen as a kind of legal loophole to simulate interest. Basically, I sell you something for, say, $100 cash today, and then I immediately buy it back from you for $110, but on deferred payment terms. Effectively, it's a $100 loan with $10 interest disguised as two sales. That's prohibited.
Ah, I see. Clever but forbidden. What else?
Non-Shari'a-compliant derivatives are a big category. This includes futures contracts, options, most index-based instruments, and swaps.
Why are these generally problematic from a Sharia perspective?
Well, often it's because they involve high levels of uncertainty or speculation, gharar, or elements of gambling, maisir. With options, for example, you're often trading a right or a probability rather than owning a tangible asset, which can be problematic. Futures involve deferment on both sides, which has issues. Swaps often involve exchanging interest payments. It's complex, but they generally fall foul of core principles.
Okay. Any other forbidden transactions that stand out?
Hire purchase agreements, where the person leasing the item bears all the ownership risks and costs, and ownership transfers automatically. At the end, that specific structure is often deemed non-compliant, as it can blur the lines between a true lease and an interest-based sale.
Right.
Short selling is explicitly forbidden. Selling shares you don't actually own yet, hoping the price will fall before you have to deliver them. That violates the principle of needing to possess something before you sell it. Got DHE.
No shorting.
Got it. Also, preference shares, sometimes called tamatu shares, are banned. These are shares that give the holder preferential rights, like a guaranteed dividend or priority in liquidation. That guarantee looks too much like interest and creates an unfair advantage over ordinary shareholders, so no issuing or trading preference shares.
Makes sense within the framework.
And finally, perhaps most obviously, any financing for buying shares that involves interest is forbidden. Whether it's a straight interest-based loan from a bank or using margin accounts where the broker charges explicit or even implicit interest, maybe disguised as higher commission, it's all prohibited. Stick to compliant financing methods like murabaha.
So wrapping this all up, wow, we've really covered a lot of ground digging into this incredibly detailed, very specific set of rules from the DFM. It governs everything from a company's core purpose and its debt levels.
How you trade its shares, the recent changes around that 10% asset rule.
How you absolutely must purify any forbidden income. And this long list of financial practices that are just completely off limits, it really drives home how deeply faith and finance can be interwoven.
It does. And if you think about the bigger picture, this DFM standard isn't solely about restriction, about avoiding the haram. It's fundamentally constructive. It's about trying to build specific kind of financial ecosystem.
One built on
principles like transparency, fairness, risk sharing, connection to the real economy, and a sense of social and ethical responsibility.
Yeah.
It really makes you think, what other parts of global finance could maybe benefit from, or perhaps be seriously challenged by, applying such a thorough ethical framework?
That's a great question. And it leads to a final thought for you, the listener. Given how incredibly detailed and explicit Sharia compliance is, defining everything down to specific contract types and financial ratios, what does this intense focus on ethical definition tell us about the often unspoken assumptions, the hidden principles that might be guiding investment decisions everywhere else, even in conventional markets? What foundations are those markets built on, if not explicitly defined ethics? Something to ponder.